When you go to buy a house, most people do not pay for it in cash, so they have to go to the bank and ask for a mortgage. Now, there's not just one type of mortgage, there's many different loan programs. We're gonna go over the most popular ones today, the repayment options for each of them, and which one is ultimately the best for you. Everyone's personal financial situation is different, so that's why there's so many loan programs available to homeowners today. We're only going to cover 4 of them because those are the main ones that people use as investors and as homeowners alike. The first one is conventional, the second one is a DSCR loan, the third is FHA, and the fourth is interest only. The conventional loan is the traditional route. 76% of all home sales are used with conventional loans. This just means that you need a 620 credit score or greater. You can get a down payment as low as 3% with these, and they're gonna use your personal income, your tax returns, W-2s to qualify you for that home. The interest-only loans are more used as investors advance in their careers when they need to lower their monthly payment as much as possible for maybe a fix and flip or something that's going to be refinanced down the road. The goal is paying the least amount every month initially until the property is completed or done with its rehab. The DSCR loans stand for Debt Service Coverage Ratio. These are loans issued to individuals and investors that have properties with incomes that are greater than its expenses. So they will issue the loan and approve you for it as long as the rental income is greater than the expenses on the property. They're not looking at you, the individual, and what you're making at your job. So in this case, it makes it a lot easier to get approved, but you typically have to pay higher interest rates for those. And the last one is FHA, Federal Housing Administration. This is an insured program by the federal United States agency, and this is going to come with the advantage of getting approved with a 580 credit score or greater, but you have a minimum payment, a down payment of 3.5%. So slightly higher than the conventional, but still pretty good. But you do also have requirements when it comes to the property you choose, meaning there needs to be handrails, no peeling paint, and other physical requirements for you to purchase the property using an FHA loan. So now that we went over our 4 programs briefly, there are different repayment options within each one. Let's go through conventional. For example, we have a 15-year fixed, a 30-year fixed, and adjustable rate mortgages, or ARMs. Now, a 15-year fixed means what it sounds like. It's 15 years to repay that mortgage in full, and your payment will not change every single month. It'll stay the same. 30-year fixed is over a 30-year period, so your monthly payment is lower than a 15-year, but it's still fixed, and the interest rates are slightly higher than with a 15-year fixed. Then you have your ARMs, and there are many different options with ARMs. You have 3-year ARMs, 5-year, 7-year, 10-year ARMs. What this means is that, for example, a 5-year ARM means my payment's gonna be fixed for 5 years, and then after that, it's going to adjust to whatever the market is at that time until the loan is paid back in full. The advantage of the 5-year ARM is that I get a lower payment initially, I get a lower interest rate, but I do take a little bit more risk because what happens after those 5 years? If I don't refinance into a different loan and it adjusts and the rates happen to be really high at that time, then my payment is gonna be a lot higher than what I was paying before. And I gotta make sure that I can afford that if I'm not able to refinance. So those are different repayment options. And I'll tell you right now, the most popular, what most people do is a 30-year fixed conventional loan. But that doesn't mean that's right for you. To determine what's best for you is gonna start with what your goals are. So why would I get a 30-year fixed when, let's say my goal is to buy the property, rent it out, and sell it in 3 years? If I know I'm gonna sell it in 3 years, I'm gonna go through getting a higher interest rate and have a higher monthly payment and do all of this for a 30-year fixed? That doesn't make sense. I would want, in that situation, I probably would want a 3-year or 5-year ARM, adjustable rate mortgage, because during the first 3 to 5 years, my payment's gonna be fixed. I'm gonna get a lower interest rate, a lower payment, and then I'm gonna sell the property, so it's not going to matter that the rate's gonna adjust after that. I can take that risk because I know I'm gonna sell at a 3 to 5 year period, right? So it depends on your goals. But like I said, as a primary residence or a first-time home buyer, almost all the time, if you can get approved for a conventional 30-year fix, that's the route to go. Maybe the second best as a first-time home buyer or somebody who just wants to move in with family could be FHA. If your credit score is lower than 620, maybe you need to look into that. There's also higher debt-to-income ratios that they allow with FHA. So if you can't get approved for conventional, try the FHA. The 15-year fixed option is gonna be great for people who wanna pay off their home as quickly as possible, but it's just really difficult to afford right now with the rates and where home prices are. It's going to increase your monthly payment, and people are already having trouble affording a 30-year fixed monthly payment. So my advice, stick with a 30-year fix right now and do your best to get approved for that. I hope you guys got value from today's video. If you did, please share with friends and family, subscribe to the channel, and have a great rest of your week. I'll see you on the next video.